Welcome to 190th episode of AAA Weekly Webinar Series. Last month, rather this month, has been eventful month. There are regulations notified, there are discussion papers where we all have to give our feedback, and even the guidelines for making an empanelment application. We are going to discuss all this today. And regarding the larger one, which is the discussion paper on valuation, that we would cover in the next episode because that's very large and it may not be covered in our scheduled time. So we would be discussing today the IBBI Insolvency Professionals Second Amendment Regulations 2025, which was announced on 20th of November 2025. We would also be discussing IBBI Insolvency Resolution Process for Personal Guarantors to Corporate Debtor Amendment Regulation 2025, again dated 20th November 2025. Then we also would discuss the guidelines which are for empanelment, where we get some cases from NCLT. We also would be discussing discussion paper dated 17th November 2025 regarding strengthening and safeguard the transparency in CIRP. That is dated 17th of November 2025. We also would be discussing discussion paper on empowering directors or partners in IPE by proposing minimum shareholding or capital contribution. This was also given on 17th of November 2025. So the very first thing that we would like to take up is the regulation, which is the fixing a cap on the assignments. That's again a regulation which is already notified on 20th of November 2025. And what it says, presently, there was a cap, but that was in Code of Conduct for insolvency professionals. For now, that cap has actually been brought to the regulations, not in the Code of Conduct. See, when there was no cap, so even IBBI was getting feedback that there is a concentration of assignments with few insolvency professionals, and other insolvency professionals are not getting assignments. And also, there is no categorization of assignments like complicated assignments or larger assignments or like smaller assignments. Then the first schedule, which is Code of Conduct, again attached to insolvency professional regulations, that was where it was required that some of the actions were required to be approved by the board. Now the clause 22 of the contain. Now let us discuss there was a discussion paper on 12th August 2025, and that discussion paper was titled as Review of Limits on Number of Assignments being Handled by Insolvency Professionals. And in that particular review discussion paper, the feedback was a high concentration of assignments with a limited number of insolvency professionals, delay in CIRP and liquidation proceedings often attributable to overburdened IPs, the need to introduce a uniform ceiling on assignments to ensure equitable distribution and timely resolution, the importance of professional capacity, accountability, and quality supervision in handling cases, a recommendation to impose quantitative limits, especially restricting high-value assignments due to their complexity and resource intensity. Now, based on this discussion paper, which was released on 12th of August 2025, the amendment which has now notified regarding number of assignments, so now the IBBI through regulations has limited the assignments to 10 assignments at any time, and that 10 assignments earlier in the Code of Conduct, The 10 assignments was there, but that did not include liquidation assignments, because the liquidation assignments are not even getting completed even if you sell all the assets. So there was a feedback to IBBI that the liquidation assignments are also getting delayed only because the liquidators are not really bothered about all these assignments, because they still have the capacity to take CIRP cases. And there is no cap on the liquidation cases, so there may be a possibility that the CIRP cases are only 3 or 5, but the liquidation cases can be 13, 14, 17. So that is what the feedback was gone to IBBI. So therefore, now this 10 assignments has actually been brought to regulations from the Code of Conduct. And also in these 10 assignments, the three kinds of assignments are included. One, the IRP assignments in CIRP, in interim resolution professional in CIRP, RP assignments in CIRP, and the liquidator assignments in liquidation. Now the cap is like, though the total cap is 10, however, not more than 3 assignments where the admitted claim exceeds 1000 crore. But the admitted claims can actually go to more than 1000 cases in many cases. So this is admitted claim exceeds 1000 crore. There is a restriction of 3 assignments, overall 10 assignments, and as far as the liquidation is concerned, that is included in the number of assignments. So in case you have liquidation assignments where the admitted claims are exceeding 1000 crores, that means you would not be able to take up any assignment where the more than 3 assignments already there, so you cannot take any assignment in CIRP where the admitted claim is more than 1000. So it is must that you should finish the liquidation assignments. So in this 3 days training program, when I said that the trust structure will work and we are getting good response from the banks, and if the State Bank of India would approve that, I think most of the liquidation assignments can be closed by assigning the avoidance transaction proceedings. Now there is a transition clause also, because there may be cases that there are many assignments which are presently being handled by an insolvency professionals, including all those liquidation assignments where some kind of litigation is going on or some kind of attachment of assets are continuing. During the transition period, the assignments can be handled. More than 10 assignments can be handled. However, that particular insolvency professional would not be eligible for taking any new assignment. So that means if any person has more than 10 assignments, that means for the time being, his AFA is infructuous. His AFA is not kind of valid because he has more than 10 assignments. So that is something which is coming as a shock to some people, that they in fact had given consents. They had given consents to larger companies, but they still have liquidation assignments. Now, when those assignments will come, they actually would not be able to take up the new assignments, so they will have to change the mandate. The creditor will have to change all those mandates where they have given the mandate to those insolvency professionals who already have more than 3 cases where the admitted claims are more than 1000 crore, which is probably possible in many cases. In many insolvency professionals cases, all those old cases where the liquidations are still going on, they would not be entitled to have any new cases till the time they close all these liquidation cases. Now, what happens in the post amendment? Now, they have added Regulation 7, capital B, in the insolvency professional regulations. And what it reads, I would actually be saying, an insolvency professional who is not an insolvency professional entity, that means this particular limit is not applicable to IPE. So there is no limit on IPE. Shall not at any point, however, when the IPE, the authorized partner, it will be applicable. On the authorized partner, it will be applicable. So in case IPE gets a case and the authorized partner is still having 10 cases, That means that individual insolvency professional, even if he is a partner to IPE, would not be able to get the case as authorized partner for that case. That is also not possible, because see, I would come to that why I am saying so. Because see, therefore, the new case, either through direct in your name or through IPE, is not possible in case you already have 10 cases including liquidation, and in case you're in your existing cases including old liquidation cases, if you have 3 cases which where we have more than 1000 crores as admitted claims, that means it is you are not even entitled to take any new case either through IPE or individually. Shall not at any point of time have more than 10 assignments in aggregate as IRP and RP in a CIRP. And as a liquidator in a liquidation process, this is something which is as a liquidator in a liquidation process, of which not more than 3 assignments shall have admitted claims exceeding 1000 crore rupees. That means for liquidation cases, for IRP, for RP. This 1000 crore is applicable to all the 3 kinds of assignments. Provision. The proviso, there is a proviso that an insolvency professional who is not an insolvency professional entity already holding more than such assignments than the limit specified in this regulation on the date of commencement of this amendment shall not accept any such new assignment until the number of his assignments falls below the limit specified in this regulation. So that means as a transition period, he will not be able to get any new cases. But the only thing is, there is only one good news, that the personal insolvency resolution process is not included in this limit. Bankruptcy cases are not included in this limit. The authorized representative, when you are actually representing a class of creditor, that is also not included in this. And also supporting any other insolvency professional as an independent insolvency professional, that is also not included. So therefore, in fact, if you recall, you have 3 more possibilities: the personal insolvency resolution process and the bankruptcy. Monitoring professional is also not included. When you are appointed as monitoring professional in a monitoring committee for the implementation of a resolution plan, that is also not considered as assignment for the purpose of a cap of 10 cases. We actually recall that there was a discussion paper that was on 20th of October 2023, when there was a proposal in that discussion paper that of course there would not be any limit on IPE as far as the total number of cases. However, there was a proposal to limit the cases to 15 for more than 1000 crore claim cases, and also 5 cases per partner. That was also considered as the proposal, but that proposal has not been notified. So therefore we can say that the IBBI has considered: 1, the IPE cannot take up a case in its own name unless there is an authorized partner. So if there is an authorized partner who already has 10 cases, so he cannot become an authorized partner for a new case. So therefore, overall limit is pertaining to an insolvency professional, either individually or through an IPE. So that is what is the law. So now in fact the code of conduct is the first schedule of the code of conduct. In fact, that is still one part which is still continuing. That part is important because see, earlier the code of conduct main part is excluded, but one part is still continuing in the code of conduct, and that part is: an insolvency professional must refrain from accepting too many assignments if he is unlikely to be able to devote adequate time to each of his assignment. So this part is still continuing, but the numerical part is deleted because it has come to the regulations. So in the code of conduct, I think the IBBI still has the power in case a person says that I have 5 assignments, but I am not able to devote time, the IBBI also see that that particular person is engaged in so many things, so he is not able to devote time. So therefore, that particular clause 22 is still existing in the code of conduct. So there is so this is what is the a complete analysis of the putting a cap on the number of assignments. It is definitely not a good news for many, and it is definitely a good news for more numbers. So I would be supporting this kind of amendment because every insolvency professional, whosoever has opted for this particular profession, should get his share or her share. That's what I would support this particular amendment. And the IPE would also have more insolvency professionals, so that either the insolvency professional will get cases in his own individual name, or he will get it through the IPE. So there is one more amendment to through this insolvency professional regulations, that is the clause 6 of the code of conduct. And earlier, clause 6 of the code of conduct was like, in cases where the insolvency professional is dealing with assets of a debtor during liquidation or bankruptcy process, he must ensure that he or his relatives do not knowingly acquire any such asset. So basically, there was a code of conduct which said that in case you are dealing with any liquidation or bankruptcy process, and you are dealing with some assets, mean that you are selling those assets which are owned by the CD or by the personal guarantor, should not acquire it. But in case you are acquiring it for any reason, then it should be with the approval of the board. It means with the approval of the IBBI. Now this approval of the board has actually been changed to with the prior approval of the adjudicating authority. So in case any liquidator or bankruptcy trustee wants to acquire any asset out of the bankruptcy process or liquidation process, he will have to file an application to NCLT, and NCLT will allow, then only he would be able to acquire. So which probably, practically, it would not happen. See, otherwise the NCLT would actually see a lot of reasons why it is being done. So therefore, it is not possible. It has to be a prior permission from the adjudicating authority. Authorized signatory is also, because see, the assignment is considered in the name of the insolvency professional, even if he is actually acting as the authorized signatory. IBBI records that assignment is still in the name of the authorized partner. So therefore, the 10 assignment that I am saying, it would include any assignment which is through IPE as authorized signatory.
So the next change is in IBBI insolvency resolution process for personal guarantors to corporate debtors. Here again on 20th of November 2025, IBBI has made certain changes in the regulations. And the regulatory changes are primarily directed towards making the resolution professionals appointed in personal guarantor matters accountable in terms of how they are already accountable in CARP. In CARP and liquidation, resolution professionals or liquidators regularly file forms. In these forms, IBBI collects information with respect to the compliance of various matters by the resolution professionals and liquidators, and IBBI also captures important data with respect to delay in the process and the reason for those delays. It is therefore now prescribed under these regulations that similar forms will be required to be filed by the insolvency professional under these regulations wherever the insolvency professional is appointed as an RP under RP for a personal guarantor matter. So regulation 23 has been newly inserted, which requires mandatory filing of forms, and the forms will be as notified by IBBI through circulars along with required enclosures strictly as per prescribed timelines. That is the required compliance. And then, of course, there is a late filing fee which is provided for that after the due date, a fee of rupees 500 per form per calendar month of delay is also prescribed. So all those insolvency professionals who have cases under their name with respect to personal guarantors or insolvency of personal guarantors will now be required to complete this filing requirement for forms under these regulations. So watch out for IBBI notifying these forms, and I believe then we will be of course required to do this compliance.
IBBI, as usual, have also issued guidelines for empanelment, which is very important for all of us. These guidelines were also released on 21st of November 2025, and we are all supposed to fill this form, and this would be used as a database, a panel with NCLT benches, so that they can appoint you if you are impaneled as RP, IRP, liquidator, resolution professional for personal guarantors cases, and bankruptcy trustee. That's what this panel is being made for. Now, the rules in fact says that the adjudicating authority would appoint with the permission of the IBBI. So in case we try and find out the IBBI and so there is a delay. So now the eligible insolvency professionals are also defined in these guidelines. One, no disciplinary proceedings, whether initiated by the board or the IPA pending against IP, not being convicted at any time in last 3 years by a court of competent jurisdiction. IP has submitted expression of interest along with the consent to act as IRP, RP, liquidator, bankruptcy trustee for appointment by NCLT. IP holds an authorization for assignment, if AFA, which is valid till the validity of panel. Means this panel is released every 6 months, and the IP is included in the panel for 6 month period. So in case, as on December 31st, in case my AFA is expiring between 1st January 2026 to 30th of June, then I would not be eligible for this empanelment. So this is something which is important. So one important part is that the board will invite IPs to submit Form A, which is attached, and that is good. This is basically a submission of interest as an unconditional consent to act as RP. Unconditional consent to act as RP. The IP can submit by 22nd of December 2025. The IPs must indicate sectors where they have handled assignments, choosing from a drop-down list. If others is selected, the sector name must be specified. If others is selected, then the sector name must be specified. Now, the adjudicating authority may select a name from the panel for appointment in CIRP, liquidation, insolvency resolution, or bankruptcy concerning corporate debtors or personal guarantors. However, this is a common panel that which is being prepared by IBBI, and the validity is for 6 months. Panel will be distributed zone wise based on the, in case your address is in Uttar Pradesh, maybe Noida or Ghaziabad, then you would be considered as on the panel of Allahabad bench, not in Delhi bench. And similarly, there is a criteria this time, or maybe even the last time was also there because I didn't apply. This time there is a criteria of sorting the RPs on ranking basis. Eligible insolvency professionals in the panel are ranked according to the volume of their ongoing assignment. Volume of their ongoing assignments. So I understand in case the ongoing assignments are higher, then they would be ranked lower. And in case 2 or more IPs have the same score, they are ordered by their date of registration with the IBBI. Seniority preference, the IP registered earlier is placed above, and the one registered later is placed lower. Now, this is also considered to be a deemed acceptance. So, in case your name is opted by any bench to be appointed for all these assignments, then it will be considered deemed acceptance. Also, there is a restriction that you cannot withdraw the assignment unless there are valid reasons and which could lead to removal from the panel in case there is no in case there is no justified reason for refusing an assignment. So there are conditions within these guidelines, and one that anyone submitting this consent would be considered as deemed acceptance of the assignment. Then the restriction on withdrawal is also there, like it will be very difficult to refuse an assignment if it is given by NCLT, and there has to be a very genuine reasons for accepting the refusal. And then the continuity of registration, like if the IPs are expected not to surrender their registration, membership, or authorization during the panel's validity period, and the adjudicating authority may even appoint any insolvency professional from the panel at its discretion. Maybe it is from the same zone or area or from any other area. The adjudicating authority has no restrictions. Even the adjudicating authority has no restrictions, even if they appoint anyone who is not in the panel. However, in case the adjudicating authority appoints an IP who is not in the panel, then the adjudicating authority will have to send a communication to IBBI for verification of the credibility or various other things from IBBI. Earlier panel that would get repealed in case this gets.
We can now talk about the discussion paper with respect to strengthening the safeguards and transparency in the CRP process, which is dated 17th of November 2025. This is open for public comments by 8th of December 25. The major proposals or key proposals that are there in this discussion paper are first with respect to real estate cases. So one change that is being talked about here is how the information memorandum should disclose the allottees in a project which are available with the RP as part of the books of accounts or as part of the records of the corporate debtor. Secondly, the requirement for the resolution applicant to treat them in the resolution plan itself. Then we have requirement for the disclosure of receivables, joint development agreements, and information of assets which are under attachment in the information memorandum. So this was not there earlier, so it is being proposed that these should be made part of the process so that, and this is coming from various Supreme Court, NCLAT, and NCLT judgments which have talked about how this being missing is creating difficulty in implementation and taking care of these processes. I will detail more about that later. There is also a process where the IBBI has taken out or come out with a proposal to safeguard the process itself where the COC is not having any major financial institution as part of the members. And there is also a requirement, a proposal to talk about the mandatory recording of reasons by the COC for recommending liquidation where the resolution plan that has been received is having a value of more than the liquidation value. Coming to the proposal number 1, where the disclosure of allottees in the information memorandum and the treatment in the resolution plan is provided for. So this is coming from a case titled Puneet Kaur versus KV Developers Private Limited and others, dated 1st of June 2022, where the NCLAT held that home buyers whose claim appear in the corporate debtors records must be included in the information memorandum even if they did not file claims. Their liabilities should be accounted for in the resolution plan, and ignoring such recorded claims results in an unfair and unequitable resolution. The Supreme Court of India later made an observation based on this principle in Amit Nehra versus Pawan Kumar Garg, judgment dated 10th of September 2025. So the proposal talks about inserting subclause JA in Regulation 36(2), where JA will read details of all allottees, including their names, amounts due, and units allotted, whose claims are reflecting in the books of accounts of the corporate debtor but have not submitted their claims to the resolution professional. We also call these, in many of our real estate cases, deferred allottees. We say that these are deferred allottees. Normally we find treatment with respect to deferred allottees because we say that their claims have not come in and they will come maybe in deferment. Then we have mandatory contents of the resolution plan. That is a new regulation, which is 38A, is being talked about, where treatment of allottees not filing claims is the heading of this regulation, which says that in respect of a real estate project where the details of allottees are reflected in the books of accounts of the corporate debtor, but such allottees have not submitted their claims, the resolution plan shall provide for treatment of such allottees in the resolution plan. This is proposal number 1. Proposal number 2 talks about disclosure of receivables, DDAs, information on assets under attachment in the IM. It is again coming from a judgment from the Supreme Court of India in Victory Iron Works Limited versus Jitendra Lohia, where it was held that development rights granted to a corporate debtor qualify as property under Section 3, subsection 27 of IBC. These rights form part of debtor's assets under Section 18F and 25(2)A. So the proposal now is to insert new subclauses in Regulation 36(2), that is for information memorandum, where AA, AB and AC will be inserted, which will read, AA will read details of receivables of the corporate debtor, including trade receivables, intercorporate receivables and receivables arising under any contract. AB reads details of joint development agreements and other similar collaboration or co-development arrangements, including rights, obligations and interests of the corporate debtor arising thereunder. And AC will read details of assets which are under attachment by enforcement agencies, including particulars of assets attached, the authority which has attached and the status of such proceedings. Proposal 3 talks about safeguarding where no financial institution is represented in the COC. So there is a proposal to insert new regulation 16E. 16E is headed safeguard where no financial institution is represented in the committee. So it reads, where no financial institution, as defined under clause 14 of section 3 of the code, is a member of the committee, and any other financial creditor solely holds more than 66% of the voting share, the resolution professional shall invite the 5 largest operational creditors by value of admitted claims to attend the meetings of the committee as observers and shall record their observations, if any, in the minutes. So it's a good move to safeguard the process as a whole, where one person or one financial creditor who is not a financial institution would not have that kind of size or that kind of regulatory framework within their organization can be limited by exploiting or limited for exploiting the CRP process due to the presence of these operational creditors and their comments in the meeting.
Now, the most important discussion paper released on 17th of November 2025, where a lot of discussions are going on regarding the stipulating minimum shareholding or capital contribution in the structure of insolvency professional entities. So this discussion paper dated 17th of November 2025, it actually raises many questions which are not discussed in this discussion paper. So we would request all the viewers to give a feedback about all these issues that we are trying to discuss today, deliberate today. First of all, there is a mandatory condition that the IPE must have a capital of at least 1 crore. Problems identified by IBBI is one, that there is a concentration of ownership that they have found in many IP is a few individuals, sometimes investor partners or dominant IPs, hold a major part of the equity. This leads to disproportionate control over decisions, diminishing equitable governance. Then it also discloses a data which says out of 233 members across large IPEs, that is 10 plus member IPEs, 181 means 77% holds less than 5% stake. Yet, even if they are holding less than 5% stakes, but they are handling more than 70% of the IP assignments. So those holding 95% of the capital handle only 30% of the assignments, that those people who are the real owners, who have contributed more to the capital, they are not taking the risk of taking assignments in their own name. So they are taking the assignments in those names where the shareholding is much lesser. Then they are also saying that there is a lack of uniformity amongst various IPEs. In some of the IPEs, the partners are having equal. In some of the IPEs, some partners are having very, very minuscule share. So therefore, it may impact the independence and the confidentiality concerns. And the key proposal in this regard, the board proposes, IBBI proposes, that every director or partner in an IPE must hold at least 5% of the paid up capital or 5% of the capital contribution of a partnership, limited liability partnership. Now, there is an exception that in case the total partners are more than 20, then it can be proportionate. Like in case it is 25 partners IPE, then 4% can be the minimum requirement for each partner. The IBBI says that this creates a uniform baseline of participation and ensures that those involved in the management have a real, not symbolic, financial commitment to the entity. Now, the rationale for the proposal, as IBBI says, that the public interest nature of insolvency professional, because this particular profession is having some public interest, and IP handles matters affecting creditors, debtors, and the entire insolvency ecosystem. Therefore, IPE structure must ensure independence, accountability, and balanced governance. Minimum stake ensures commitment. When every partner director has financial participation, they naturally share risks, rewards, governance, responsibility, and long-term commitment. It aligns stake with contribution, especially for those managing or most assignments. The uniform minimum stake prevents arbitrary or concentrated ownership models and allows IBBI to monitor IPE more effectively. Ownership participation reduces undue external influences and protects the confidentiality of sensitive information handled by IPs. Public comments are asked and the last date is 7th of December. I was deliberating with some of insolvency professionals, and I could find that there are many questions which actually is arising out of this discussion paper. Number one, the Limited Liability Partnership Act, the Limited Liability Partnership Agreement or the Shareholders Agreement. These are governed by different laws. The Limited Liability Partnership Agreement is governed by the Limited Liability Partnership Act, whereas the Shareholders Agreement is governed by the Companies Act. So there are no changes which are proposed in these two acts. Also, as far as this income tax department is concerned, income tax department permits that there can be a fixed capital of partners and there can be a current capital account. And the current capital account can be variable, whereas the fixed capital account can have 1 crore of capital and everyone can have 5%, whereas the current capital account, which keeps changing, where the withdrawals and where the insertion of capital, it keeps happening throughout the year or even over a longer period. So there is a fixed capital and there is a current capital account. It is applicable to fixed capital and it is not applicable to the current capital. That is something that needs to be resolved. Secondly, it also the minimum capital share does not ensure a fair profit sharing. The LLP Act allows profit sharing ratio to be entirely unrelated to the capital contribution. Similarly, a few partners may retain disproportionate profit rights, defeating the intended alignment of stakes and reward. But that's what, as per the LLP law. This could perpetuate the very imbalance the proposal seeks to correct. Implication of this particular apprehension, where the capital can be 5%, but the profit sharing can be any amount, totally irrespective with the capital contribution. The minimum capital requirement alone cannot guarantee equitable participation in economic outcomes. The contractual arrangements can override regulatory intent. Limited liability partnership agreement or shareholders agreement may include clauses where the profit sharing ratio shall not correspond to capital contribution. Certain partners have enhanced voting. They can also have some veto power or governance rights irrespective of their financial stakes. These contractual freedoms are protected under Limited Liability Partnership Act 2008, Companies Act 2013, and the Contract Act 1872. So the implication of all these contractual arrangements on the governance provisions or on the control provisions, this actually cannot be neutralized by this proposed amendment. Many IPEs are promoted by larger international brands or even domestic brands. They definitely have to protect their brands, their intellectual property rights. So they can add into the LLP agreement or shareholders agreement that the brand equity, trade name, goodwill, or even the intellectual property will belong to founding partners or a few partners. Those partners may hold minority capital but retains majority control over brand intellectual property rights. Now this creates asymmetry in actual influence, risk of indirect control, and dependence on IPE operations on brand owners who may not meet the minimum stake requirement. So therefore, regulatory threshold on capital will not automatically align brand intellectual property control with professional governance. Now the decision making, the agreements like LLP agreement or shareholders agreement can actually stipulate the decision making powers, decision on removal or admission of partners, induction of investors, or strategic control matters, bank account operations. All this can actually vest with some few partners who are not having matching capital contribution or matching shares. This all can happen through LLP agreement or the shareholders agreement, even if they do not hold majority shares. Now, the implication of all these control powers in LLP agreement or in the shareholders agreement that actually can result in effective control resting with minority shareholders or minority stakeholders, disruption of the intended objective of uniformly distributed governance, continuation of the structure which is presently going on that can still continue. Now, there are various such agreements which actually can prescribe the operational decisions, like the where would the office would be office of the IPE would be restricted to a particular place, or over the certain administrative powers, operational powers like engagement or recruitment of employees, the salary of all the employees, that all can be retained by a few partners or even partners who are having minority stakes in the shareholding or in the capital. So such provisions in fact can limit governance flexibility, and it can actually block democratization of decision making. Various such clauses in the LLP or shareholders agreement which can actually have differential voting rights, side agreements that actually can be signed between the partners, management rights agreements, like intellectual property licensing models, profit sharing waterfalls favoring a few partners. So the implication of all this would be that the objective of the IBBI would not be met out because of this amendment. Now the complexity with the large IPEs, I mean, of course, like in case the IPEs are having more than 20 members, and that's a gray area whether the capital requirement at times is much more than the 1 crore, because there may be a few crores of receivables. If the billing has been done and there are receivables outstanding, and who would bring the capital to meet the expenditure? If those capital is brought by one partner, how the other partners can bring 5% matching equity? But in case the other partners, few partners, are bringing all that additional requirement in a current account, whether the current account of a partner would be considered as a capital account or not, all these are questions. And unless these questions are resolved, I believe this is prone to litigation and this is prone to various actions by IBBI. So based on all this, I believe everyone should give feedback that the objective of IBBI by changing the capital contribution or shareholding pattern, this actually would not meet the objective. Any time the capital can be required to be increased, because see, the money has not come, money is not released by the corporate debtor, the clients are not giving money. So all this, the expenditures are being incurred. Immediately there is an additional requirement for making payment of salaries and rent. So then, not that possible all the 20 partners will bring additional money. That has to be brought by one. How can it be matching all the way, all the time? So there has to be a concept of current capital account or current account of the partners. So whether the current account of the partners will also be considered as capital contribution or not, all these are questions. So this is where, therefore, even if some kind of law is brought, it will only create litigation and will not resolve this issue.
One, I think that there are two parts to this problem. One, that capital contribution is something that is not there from many partners. So they don't effectively have skin in the game. That is one problem that IBBI is trying to address in my understanding. The second issue is governance, that okay, one person has higher vote share, so he decides what will happen in this entity or what will happen. And the third problem, I think, is also a big problem, that those who have share in profit are not having cases in their name, and those who don't have share in profit or don't have capital contribution have cases in their name. So it seems to IBBI that the cases are actually being run by, or rather being taken care of by some of the partners, but the authorized signatory is somebody else. So I believe that the way that it can be solved is, one, saying that rather than 5% as the minimum requirement, one can say that in case the minimum requirement, total requirement is 1 crore rupees as capital, each and every partner, as long as partners or shareholders are less than 20, have to bring in 5 lakh rupees as their capital, so that they have some money which is invested in the IP, which can be lost in case something goes wrong in the IP. That can be one solution. The second can be that wherever there's an authorized signatory in the entity which is taking care of some case, they should be having at least a certain percentage of the entire revenue that comes from that case towards their profit share or towards their withdrawal. So something like that, I believe, can solve IBBI's objectives here.
I think the Association of Insolvency Professional Entities, they are holding a round table discussion, and we would like to discuss and we would like to propose something to IBBI which is doable and also not prone to litigation. That's what is our endeavor. Although the practically it is not possible, and even the larger houses, larger industrial houses, larger corporations, it is also very important that there has to be a control with one or two people. If you're having control with 20 people, it is difficult to run organizations where the decisions are required to be taken immediately because of the timelines under the IBC. Thank you very much.
In case you have any questions on today's episode, do put that in the comment section. We will be happy to answer your questions.